Let's get reaction from our guest, Charles Schwab, Senior Investment Strategist, Kevin Gordon. Kevin, good to have you here. So you heard Daly saying things look good now, but you've also talked in the past about the impact policy uncertainty is having on business confidence. How do you see that playing out in the markets for the rest of the summer?
Yeah, well, so far, I mean, the uncertainty has been more on the survey-based side of things, where you look at things like capex intentions and the lack of capital spending that's at least planned for companies because of the tariff policy uncertainty. I mean, I would characterize it maybe less as uncertainty and more as instability, because that's probably more of a fair way to characterize it. But as it I think pertains to markets, the way we think about it is path of least resistance from the beginning of the year for tariff rates is higher, but path of least resistance from the ultimate peak has been lower. And I think that's been more of the focus, since the April 8th lows for the S&P 500. Clearly, the reversal or the pause in the high tariff rates was what has driven, or has been a big reason of what has driven us, off those lows and back near record high territory. So from here, our thinking about this for the back half of the year or going into 2026 is, how does the market digest a higher tariff rate, effective tariff rate than what we had at the beginning of the year, but how does that ultimately weigh on the economy, in particular the labor market? I think that's what I was really paying attention to during Mary's interview was, what is that line between softening and quick weakening in labor? And I think eventually in the back half of the year, that's going to be the metric to focus on, and things like the unemployment rate, which has, by the way, risen every month this year so far, if you take out a couple of decimal points.
How are you factoring in the various unknowns, including what the ultimate tariff rates will be with the most important partners, what's happening with consumer credit, how that might affect the back half of the year, especially Q4, and then how much inventory has come in already ahead of those expected tariffs coming on full force? Yeah,
the inventory story and the export-import differential is going to be a huge driver of GDP volatility this year. I mean, you're already seeing it from first quarter, weak headline GDP, but underlying business investment or consumer spending was strong. You're probably going to see not a complete reversal in the second quarter, because we still think that business spending and consumption will remain relatively healthy, but you're probably going to get a pretty significant jump in GDP because of the reversal of the export-import data, and probably a reversal of some of the inventory data too. So you're probably going to have maybe 2025 as a full year of those kind of swings in GDP. So it's going to be less focus on the headline, more focus on the underlying subsurface activity. But we would view almost all facets of economic data that way, especially company earnings. Don't necessarily look at what the top line or the bottom line is. Even look at the guidance and how companies are approaching tariffs and what they're doing to sort of stomach some of the volatility. And because even within sectors, if you look at consumer discretionary, if you look at consumer staples, companies have had very different reactions to tariffs and how they've been able to digest them, whether it's passing it on to the consumer because they don't have the buffer to do it, or the buffer to take it in their margins, or taking it in the margins because they built up enough of a buffer, going into this.
Yeah, I thought that was interesting too when Mary Daly made that comment that some of the CEOs she's spoken to have said that even if they're taking on more cost tied tariffs, that they're not pushing it out to their end users as well. So a dynamic to watch. How do you assess and navigate geopolitical risk? And we're going into the weekend. It's a little bit calmer based on the president's headlines we just got, but it's certainly not over.
Yeah, I mean, it's a new normal, it seems, unfortunately, to have so much, tension around the world and literally, wars that are happening. Now we've got 3 really to track. I think that as it pertains to U.S. growth and the hits eventually to U.S. markets and the economy, clearly everything runs through the energy channels. So that's why there's been so much focus on whether the Strait of Hormuz is, actually closed or blocked, and that starts to affect how global oil is shipped around the globe. If that doesn't happen, you probably have, a little bit more of a buffer for the economy, at least in the U.S. And I would add, too, if you look at energy spending and the share that it commands as a percentage of overall consumer spending in the U.S., we've come down from a peak of just above 9% in 1980 to 3.5%, 3.4% now. So you're not going to see as much of a pass through to the consumer, for various reasons. I would say the number one being that we've become a net oil exporter, and we've become a little bit more, energy dominant and independent. So there's less of a pass through effect there. But as geopolitical tensions, go as far as they go, that's probably where you see most of the hit, if at all.